Okay, let's go ahead and get started. My name is Kathy Lien, and I'm managing partner of bkforex.com as well as MD of FX Strategy for our research website, bkassetmanagement.com, which of course I encourage you to read. Now, before I begin, I'm obliged to read to you this disclaimer, so if you'll bear with me 1 second, I'll try to go through it quickly. Past performance is not indicative of future results. Trading Forex carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to trade any such leveraged products, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility is this, that you could sustain a loss of some or all your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with trading on margin and seek advice from an independent financial advisor if you have any doubts. The information, including commentary and trade ideas presented on bkforex.com, should not be relied on as a substitute for sensitive independent research, which you should be performed before making your investment decision. BK Forex LLC and bkforex.com are merely providing this information for your general information. The information and opinions presented do not take into account any particular individual's investment objectives, financial situations, or needs. All investors should obtain advice based on a unique situation before making any investment decision and should tailor their trade size and the leverage of their trading to their personal risk appetite. BK Forex LLC will not be responsible for any losses incurred on investments made by readers and clients as a result of any information contained on BK Forex LLC. BK Forex LLC do not render investment, legal, accounting, tax, or other professional advice. If investment, legal, tax, or other expertise is required, the services of a competent professional should be sought. Okay, so with that out of the way, what we're going to talk about today is really the dynamics in the markets right now, what's happening in the euro, what's happening in the U.S. dollar, and what's next for each of these currencies. The big story, obviously, is the major moves by central banks over the past 2 weeks. Ben Bernanke and ECB President Draghi have made significant forays in terms of unconventional monetary policy. That's sent the euro-dollar sharply higher, which may make sense to some people and not so much for others. But at this point, the more important question to ask is what's going on and what does this mean for currencies going forward? In general, central banks have been revving up the printing presses, and they're doing this because the outlook for the U.S. and the Eurozone economies is quite dismal. In the Eurozone, we've got austerity measures that's really weighing on growth in the region. There's a number of countries that are deep in recession, and that poses big trouble for the outlook of the economy. And at the same time, the bigger problem for the Eurozone is the possibility of another country requiring a sovereign bailout. So, there's a widespread fear that Spain and Italy would be next. So that is why the European Central Bank decided to introduce what they call OMT, outright monetary transactions. And the goal of that was to come into the market and basically take additional initiatives to keep yields low. So that's what they did. The Federal Reserve, on the other hand, announced a third round of quantitative easing. We'll talk a lot more about this in further detail. I know you already have eager questions coming in, and we'll address them all, I promise you. But first, let's begin by talking about what the ECB did. The ECB, at the beginning of the month, introduced a program called OMT. And it lit the euro-dollar on fire. And the rally in the euro-dollar was only compounded by the action by the Federal Reserve last week. For most investors, OMT is just another ingredient in the central bank's alphabet soup, which already includes, for those of you that remember, S&P Securities Markets Program, EFSF, and ESM. But this one, unlike some of the others, has been enough to drive the euro-dollar to a 4-month high. And, with possibility of even greater milestones being reached in the weeks to come. Now, if you're wondering why investors and economists are so excited, this is what we're going to try to talk about a little bit about today. OMT is basically outright monetary transactions. And just to give you a little insight into how they work, for the ECB in particular, OMT basically involves an outright transaction to buy bonds of a specific country on the secondary market. And the ECB basically said, okay, we're willing to come to the market and buy Spanish and Italian bonds or bonds of Portugal, Greece, any of these other countries on the open market. And the euro dollar was lit on fire. But I think one of the important things to remember is that in order for OMT to happen, a country X, needs to first admit that they have a problem. Just like AA, Alcoholics Anonymous, the first step to bailouts is to admit that you have a problem. So they need to admit that they have a problem, and then they need to officially ask the European Union and the IMF for help. So, we're really excited about how the euro dollar has moved. The euro dollar has moved significantly over the past few weeks. We'll talk about how the dollar has impacted that, but from a euro perspective, is the rally warranted? In some ways, yes. In some ways, no. Yes, because the ECB made a huge overture to the markets and said, we will be here to buy the bonds But there's a qualification that isn't really talked about all that much. And that qualification is we're here ready to buy the bonds if a country asks to do so. And, one of the countries that we focus on so heavily on is Spain. And unfortunately, Spain, Prime Minister Rajoy, I hope I didn't butcher his name, has shown very little willingness to, get on his knees and beg the EU and the IMF for help. And with the recent decline in Spanish bond yields are back below 6%, they may not need to, because previously they had risen above 7%, which is a huge deal. But now that they're back below 6%, not such a big deal. So the ECB's OMT program can't even go into effect until country X actually asks for help. Then, once we get country X asking for help, it doesn't just happen there. There's another process. The next process that happens is that, country X goes to the table and, finds out what the EU and the IMF's terms are, or the to-do list to provide them with the support. So the EU and IMF would then lay out a deficit reduction program that country X would need to abide by. So they need to agree to, these will obviously be pretty stringent terms from the EU and the IMF. They generally have two options when it comes to this. There's two options of the programs that they're floated into the market. The first option is what we call a full macroeconomic adjustment program, which basically is similar to what's happening in Portugal, Ireland, and Greece. So they would have to be willing to give up, partial control of their partial fiscal control of their government in order to have the ECB agree to buy their bonds. Option number two is a precautionary program, which is kind of like a line of credit and would be something that's a little bit more agreeable to a country like Spain or Italy. Only after country X begs for help publicly and they agree to the stringent, and the EU and IMF figure out the terms are, and they agree to these stringent terms, will Super Mario come in and save the day by buying the short-term bonds of these countries. And if you remember, the ECB agreed to buy, short-term bonds of 1 year to up to 3 years. And the whole goal is that they would come in, they would agree to buy these short-term bonds, and by being the buyer of last resort, what they're doing is that they're effectively keeping borrowing costs low and making debt service more manageable for the country. Some additional things to keep in mind. The reason why buying bonds is so effective, or what they hope to be effective, you hear a little hesitation in my voice because they hope that this is effective, is because bond prices and yields have inverse relationships. The whole idea is that, if they buy bonds, they're boosting the prices of bonds, and in effect, that's lowering the price of bond yields. So 3 additional things that they added, some good, some bad. Number 1, OMT is unlimited. I would not underestimate the psychological impact of the word unlimited, because both the ECB as well as the Federal Reserve basically said they're coming in on an unlimited basis to buy, from the ECB, European bonds, from the U.S. bonds. And that is what gave the Euro the power to move as strongly as it has in the past couple of weeks. Bond purchases are sterilized. This is not good. Sterilized bond purchases waters down the effect of what the ECB would be doing. Because by sterilizing bond purchases, what if they're effectively doing is they're neutralizing the impact of the balance sheet. And the only thing I need to use that it's not as good as if they leave it unsterilized. But they agreed to this cool little Latin term called pari passu, which means that they basically agree to give up their seniority when it comes to being reimbursed in the case of a default or a debt restructuring. So meaning that if Spain suddenly defaulted on a loan, ECB is telling you in advance that they're not going to stand in front of you in terms of on the line to get repaid. They will stand on equal footing. So the reason why this is so good is because this gives investors a confidence that if Spain were to default or have a credit event, that they would have a good place in the line of being, or at least a fair place in the line of being repaid. Will this be enough to save Europe? Probably not. The ECB is still using monetary tools to solve fiscal problems. What Europe really needs is a major fiscal change in the form of a real fiscal and banking union, along with a convincing plan to promote growth, because that's really what needs to happen. We need a growth program in order to jumpstart the European Union and Eurozone as a whole. So this is what we take into consideration when we think about how much of an impact this could have in the euro-dollar. Yes, it's great news, and yes, we've seen a really nice rally in the euro, but until we get a country that actually asks for help, this is not going to be implemented, and and it still may not be enough to save Europe because we need fiscal change. So how can this impact the euro-dollar? Well, our best kind of parallels are when we had those long-term refinancing operations in the euro-dollar. So we're actually going to move to a live chart right now to take a look at how LTRO1, LTRO2 impacted the euro-dollar and what this means for this new bond purchase program. So right now, you should be looking at a chart of the euro-dollar, and I'm actually going to refresh my screen so hopefully you can see my chart. Okay, so right now you should see a chart of the euro-dollar. So LTRO1 came in December of 2011, pretty much around this period right here. And so LTRO1 meant that the European Central Bank came in, they were printing money. Well, they don't really print money, but they were effectively flooding the market with liquidity and devaluing the euro-dollar. And what that caused was a move in the euro-dollar that went from about 130.75 to a low of 126.25. About a 3.5% move lower in the euro-dollar. LTRO2 came towards the end of February, which is right around this period here. And let me just fast forward my chart. Depending upon where you look, you could say that it went from about 134 all the way down to the low of 120.55. So this was a much larger move in the euro. Obviously, other things are happening this time. If we just look at the initial move, we still had about a 400 pips move lower within the next month, or at least 2 weeks, in the euro-dollar after the second round of LTRO. Right now, obviously, we're having the completely opposite move. Instead of the sell-off that we saw in LTRO1 and LTRO2, what we're seeing instead is a rally in the euro-dollar. So you may be wondering why and what makes this time different. And what makes this time different is really the psychological impact of the word unlimited, because LTRO1 and LTRO2 were constrained programs, and this program was more of a unlimited program, which psychologically was very, very significant. And marked a huge move on behalf of the ECB. So, back to our slides. Let me refresh this. Okay, back to our slides. Let's talk about the Federal Reserve, which kind of whose action caused the second move higher in the euro dollar. First and foremost, as you all know by now, the Federal Reserve basically announced a third round of quantitative easing. They revved up the printing presses, and in the case of the Federal Reserve, they actually do, create new money. Obviously, it's not like this. They don't necessarily, roll out the printing press and start printing out new dollars. But essentially, that's what they're doing. They're flooding the market with new U.S. dollars, which is why the U.S. dollar performs so poorly, because they're creating more dollars in the market. So what do we get? What we got from the Federal Reserve was the following. Number one, $40 billion per month with no end date. That is where the unlimited comes in. No end date. The fact that we have no end date means that the Federal Reserve will keep on being in the market until they need to stop. And this is where, once again, I have to say that you cannot underestimate the power of and the cycle of the word unlimited, because investors clearly like what they see. They also pledged to do more if the labor market doesn't improve. They extended their low rates pledge from late 2014 to mid-2015. And they came out and said to us, even if the U.S. economy recovers, we are going to keep on buying, or at least keep monetary policy easy for a considerable time after the recovery. So this is a huge menu of initiatives that they launched last week. And one of the big reasons why we had this nice risk-on rally, and we had such a nice, powerful move in the market. Some of you are asking about whether this risk-on rally will continue. I will address that, but I want you to appreciate the significance of what the Federal Reserve did. This represents a huge shift in the level of aggressiveness by the U.S. Central Bank. And, we had QE1, we had QE2, this is QE3, and it has and it should continue to have a large impact on the market. In order to understand the current market's price action and what could unfold, going forward, we have to take a look at what really happens when quantitative easing occurs. So as I mentioned earlier, the central bank does not roll out the printing presses and actually physically, print more U.S. dollar bills. Instead, it's an electronic action these days, and they just basically add a few zeros in their bank account, and poof, like magic, money is created. So then they use this new money to buy government bonds or assets of other financial firms. This time the focus is on mortgage-backed securities. So they use this new money to buy mortgage-backed securities in the hopes of keeping the yields low. And in the hope of that the companies who get these new monies into their hands will lend to consumers or businesses and buy other assets such as bonds. And they hope that this will create a virtuous cycle of spending and investment. The impact on QE is the following. It is exactly what we're seeing right now, which is that QE is really positive for stocks. And the reason why it's really positive for stocks is because, there's a flood of cheap money into the market. So it becomes much more inexpensive for these companies to borrow, and it basically creates a floor in the bond market. It is very negative for the U.S. dollar because they're effectively devaluing the value of the dollar and, kind of tapping the rise in, U.S. yields, or at least actively pushing U.S. yields lower, making it less and less attractive to own U.S. dollars. Now, because it's good for stocks, it's also good for banks flooding the markets with liquidity. They're basically, buying up all these different things, making, your credit card interest rates lower, making your making the any sort of home loans that you may have, that interest rate lower if you have variable mortgages, making the cost of borrowing for companies lower. So all of these things is making it a very favorable environment for companies and consumers. And in that environment, it makes investors optimistic, which is why we have such a nice risk-on rally. And for the U.S. dollar, and what a good example, a good parallel is, imagine if you have one Babe Ruth baseball card. And for those of you that are not Americans, Babe Ruth is one of the most famous baseball players in the world. If you have one Babe Ruth baseball card and it was worth $100, for example, if suddenly, 4 other Babe Ruth baseball cards appeared on the market, your one Babe Ruth baseball card would be worth less than the $100. So this is why we're seeing the movement in the U.S. dollar, where originally we had X amount of U.S. dollars. Federal Reserve created money flooding the markets with, XYZ in U.S. dollars, and that's why the U.S. dollar is fallen in value. So the U.S. dollar has fallen quite a bit, but what's interesting is that quantitative easing itself is not always negative for the U.S. dollar. And if we take a look at how the euro dollar and dollar yen performed in QE1 and QE2, we can see that. This is a chart of the euro dollar, and the arrow pointing is when QE1 was announced. And what you'll see is, actually in the first, week after QE1 was announced, we actually saw a rally in the U.S. dollar against the euro before we saw a parabolic move higher. In dollar yen, we saw a much more consistent move lower. Now, what I do want to bring to your attention is that at the time, dollar yen was trading at a much higher level at 95. But when QE1 was announced, we saw a little bit of a consolidation in the day of QE. Obviously, it was very negative for the U.S. dollar. In the days that followed, we had a little bit of a consolidation before a much more serious breakdown in dollar yen. QE2, interestingly enough, actually marked a near-term bottom for the U.S. dollar. Because when QE2 was announced in 2010, we did see the dollar fall on the day of the announcement. But in the month, I would even say the month, plural, that followed, the dollar actually rose really strongly against the euro. And the same story was seen in dollar yen. Basically, in the month that followed quantitative easing 2, we actually saw a really nice rally in dollar yen. So right now, what are we seeing? Right now, what we're seeing is we're seeing the U.S. dollar sell off, but it's selling off against everything except for dollar yen. And I'll explain why dollar yen is having, a unique reaction. But what makes it different this time around and why we're seeing such a strong rally in the euro dollar, whereas in QE1 and QE2, we did not see that. In QE1, we actually saw a sell-off in the euro dollar shortly thereafter. In QE2, we saw a huge sell-off in the euro dollar, for the months that followed. The reason why it's different this time around is because, first of all, you're having simultaneous easing by the ECB and the Federal Reserve. So the difference this time around is really with regards to messaging. Central banks are telling us that they're basically in it to win it. They have absolutely no fear of coming into the market with as much money for as long as possible, and basically for as long as it takes. So they are all in. QE1, QE2, ECB, LTRO1, ECB, LTRO2 were all limited programs. The difference here is that it's unlimited, and that may be the reason why we are seeing such a larger move in the euro dollar. but will we see euro dollar 150? This is something that, for those of you that have been watching CNBC Money in Motion, and if you haven't watched it, I encourage you to do so every Friday, except for this Friday because, I'm traveling. We have a currency show, and we address these issues. One of the topics that we addressed was euro dollar 150. And I'll send you a link later on, just give you a clip if you haven't watched it. Can everyone hear me? Someone's saying that they can't hear me. Can you just clarify that you can hear me? Can you hear me? Okay, perfectly. So euro dollar 150. This is a good time anyway for me to flip back to my charts because I have planned to do that. So let me refresh my chart so you can see this. All right. So right now you should see my euro dollar chart. The question before us is we had a nice rally in the euro dollar consolidating a little bit here. Is it possible for us to get up all the way to 150? Well, in order to answer that question, we have to look at the last time we were at 150. And the last time we were at 150 was basically in the beginning of 2011. So the last time we were at the euro dollar, where we had a really nice parabolic move that basically took the euro from 129 all the way up to a high just shy of 150 at 149.40 was in 2011. Now, I personally do not believe that we're going to go to euro dollar 150 because what was happening in early 2011 was very different from what is happening right now. In early 2011, if you remember, the Federal Reserve was in the middle of QE2, because remember QE2 was announced in November of 2010. So we were in the middle of QE2 in the U.S. The ECB, on the other hand, raised interest rates for the first time out of two that year. So the ECB was raising interest rates, the Federal Reserve was easing. So we had these two completely divergent monetary policies that propelled the euro dollar higher and helped it, rally as strongly as it did in early 2011. Right now, however, we're in a completely different market environment. This is obviously not the same scenario that we're in right now. Right now, both the Federal Reserve and the ECB is moving simultaneously. So I think that, in terms of 150, it's not going to happen. But 135 in the euro dollar could happen. Because if you take a look at how the euro dollar is moving, the next clear resistance level, there is some resistance in the euro dollar at around 132.75. But the real resistance, which is basically, these highs here, the real resistance in the euro dollar is up at 135. All right, so going back to the slides. Give me 1 second to refresh my screen. All right, so going back to the slides, I'm going to refresh my camera. The next question that people have, aside from whether the euro dollar is headed for 150, is whether we'll see Bank of Japan intervention. What is the risk of Bank of Japan intervention? Well, first of all, the Bank of Japan really does not want to intervene into the markets because they know that this is not their problem. And intervening in the markets to sell the yen will only have a limited result because since it's not their problem, there's only so much that they can do to solve the problem. Because the reason why the U.S. dollar is performing so poorly against the Japanese yen is because no one wants to own U.S. dollars. So as a result, the BOJ really, or the Bank of Japan and the Ministry of Finance really do not want to come into the market. But if they need to, they will. In terms of the risk of Bank of Japan intervention, the Bank of Japan intervened at least 3 times last year. The last time they came into the market was in November of 2011. And the range that they intervened in last year was between 75.50, which is basically the record low of dollar yen, and 76.50. Right now, in terms of dollar yen, we're trading above 78. So pretty much, as long as dollar yen holds above 77, which the Japanese government allowed the currency pair to trade at multiple times last year, we're pretty much safe, in my opinion. And there basically, probably won't be much intervention. But if we see Bank of Japan, you guys want charts, so I'll just load up the charts to show you. Let me refresh my camera. All right, dollar yen. So this is dollar yen. And so the last time the Bank of Japan came in was in November of 2011. And so the low that the currency pair dropped to that month was the record low in dollar yen of 75.57. They came in again right here. Let me zoom in my chart. They came in again right here in August when the currency pair was trading, around 76.95 or so. And they came in again around here in March. And at the time, they let the currency pair drop as low as 76.50. So pretty much they've basically intervened between the 75.50 and 76.50 region. Right now, we're at 78.65. If we fall below 77, that's when the risk of intervention increases exponentially. But as long as we're above that level, then, in my opinion, we're safe. So, what I do want to call your attention to, give me 1 second to reload my slide, is the fact that we could be in an environment where the drivers of dollar yen are beginning to change. For the past 2 years, dollar yen has had a very strong correlation with U.S. 10-year yields. And this shows you the chart of how closely these two instruments have been moving together. The orange line is dollar yen, the white line is 10-year bond yield. So they've been moving pretty much in unison with 10-year yield leading dollar yen. But this could change. And the reason why this could change is because we could be moving into an environment where U.S. yields can't fall much further. And so if there's a limited downside to a U.S. yield, then what we could see is we could see an environment where dollar yen starts to move on risk and not necessarily on yield. And so it could be an environment kind of like what we saw on Friday, where dollar yen was moving with stocks and not with bonds. So I would be watching for that, because that could be something that becomes a bigger story in the coming weeks. All right, so moving on to risk ahead for the euro. Unfortunately for the euro dollar, the same problems that we've had over the past 2 years are the same problems that we need to deal with going forward. Because in order for any of the programs for the ECB to be, as announced, to be implemented, we need, one of these countries, Spain and Italy is the one that we're watching, to come into the market and beg the ECB for help. So we've got a couple of things that we're looking forward to. We've got the EU Leaders Summit in October, where we're hoping for some type of action. We still have the open question of whether Spain needs a sovereign bailout, and we still have the risk of slower growth from the Eurozone. So the pigs and the sovereign debt crisis, unfortunately, is still with us in Europe, and still something that can pose a risk for the euro. Risk ahead for the U.S. dollar is the huge, big, and looming fiscal cliff. In terms of the fiscal cliff, for those of you that aren't completely up on the story behind the fiscal cliff, basically, when it comes to the fiscal cliff, and when President, sorry, let me just drink a little bit of water. All right, so with the fiscal cliff, it's basically a ticking time bomb, because President George W. Bush enacted all of these tax cuts and discretionary spending programs that are set to expire at the exact same time in January of 2013. And the whole idea here is that if Congress does not extend these cuts before they go into effect or expire at the beginning of 2013, Americans could be hit with a really hefty increase in taxes and reduction in government spending that could have the power to push the U.S. economy back into recession. Here are the numbers. At more than $600 billion, or the equivalent of 5% of GDP. The fiscal cliff basically could plunge the U.S. economy back into a huge downturn or a huge period of slower growth. For the average taxpayer in states such as New York, New Jersey, and Connecticut, next year alone, the expiration of tax cuts could require these taxpayers to shell out another $5,000 in taxes next year, which is obviously no small sum. I mean, just imagine how you would feel as a consumer and how your consumer spending patterns would be if you knew that you would have to pay another $5,000 in taxes next year. The people at Bloomberg, using Goldman Sachs data, put together this fantastic graphic illustrating how the U.S. economy would perform if the tax cuts were to expire. As you can see, if the tax cuts are extended, then we get a solid black line, and the U.S. economy would continue to recover and maybe even at a faster pace in 2013. If the automatic tax cuts and spending programs end, then we get the dotted line, which is a really ugly scenario. The dotted line could lead to a contraction in growth of as much as 4% in the first half of 2013. And according to a report commissioned by the aerospace industry, this could mean a slashing of as much as 2 million jobs. 2 million jobs. So Congress can disarm the time bomb at any time, but they have had years to do so. But unfortunately, the highly partisan nature of the current political environment has led to very little progress. The elections is now less than 3 months away, actually less than 2 months away, which means that reaching a compromise could be even more difficult. So we don't expect any solutions until after the November election. And depending upon who wins and which political party will lead the country, that will tell us how this fiscal cliff will be handled. And rest assured, this will be the #1 priority of the winner of the 2012 election. Right now, the only solution we have is a stopgap measure that will get us slightly past the election and, by the new president's time in order to figure out how to end the fiscal cliff problem. So with that, we talked about, what the risks for the Eurozone are. We talked about what the risks for the U.S. are. Before I open up the floor to questions, so bear with me, I'd like to talk a little bit about what we do at bkforex.com. At bkforex, we offer short and swing trading signals. You can find out all the information about what we offer at bkforex.com. We're going to be launching some exciting new services very soon, known as the BK Trading Club. This is a snapshot of our brand new website that's going to come up in the beginning of October. Right now, though, we offer trading signals, and our focus is trading the euro-dollar, as well as taking some of these ideas that we have talked to you about and the outlook in the currency market, and giving you some, more swing trading opportunities based upon that. We communicate with our clients, via text message. We send you the trade alerts via text. We have a private Twitter feed where we post all of our trades, as well as on our website and over email. Every trading signal is based upon fundamentals, technicals, and sentiment, because we believe that this is about learning as well. And every trade comes with what we trade, why we trade, as well as stops along the way. What can you do today? I encourage you, if you don't do so already, to follow me on Twitter. My handle is at Kathy Lien FX. I'm tweeting throughout the course of the day, especially when we have really busy, exciting days like the Federal Reserve announcement. There's a lot of things happening on. This is free. I encourage you to follow me on Twitter because this is really what everyone is using as a channel for research these days. I also encourage you to visit our website, bkassetmanagement.com, because a lot of those things, I'm going to flip over quickly to the website. because I want to show you a lot of those things I talked about today, such as what is the fiscal cliff, what is the ECB's OMT program, is explained in our weekly education center. If you click on that, you get what is behind the ECB's monetary policy transactions. We have lots of details outlining it, and we even have a video explaining some of these fundamental concepts. And then I would even, under educational articles, I would even actually, the best way to reach this is to go under behind the ECB's outright transactions, delete the rest of this, and just go to our weekly education center. And you can see we have videos explaining what is the U.S. fiscal cliff, what is EFSF, ESM, what can the Eurozone do to halt the Eurozone debt crisis, what is LTRO, what is quantitative easing, how can negative yields exist. So we explain a lot of these fundamental concepts. And you can always, receive our emails delivered to your inbox by putting in your information here. And one of the things that we talked about today is outlined in this article here. Japanese yen intervention, is it a realistic risk? I actually talked about this on CNBC and outlined my possible trades. I encourage you to watch this video so that you can get a greater sense of that, and as well as to read this article. And then finally, you can watch, money in motion videos as well here. CNBC, the whole money in motion, where we talk about the euro dollar, we talked about dollar yen, and so I encourage you to do that by clicking on the videos. Click on any of these videos, it expands, and you can watch the video right there on our website. Okay, so with that, what I would like to do is open up the floor to questions. So I'm going to go back and take a look at some of these questions that have been put in earlier. The only thing that happened in Europe is that yields went down, problems are still there, or as soon as yields go up, chaos will return. I agree, which is hopefully what I addressed today in today's segment as well. I think the risk-on mode from last week is here to stay. I do believe it's here to stay, but we could have a little bit of pullback, which would be an opportunity probably to get in at better levels. The Germans are not excited about OMT. They're starting to talk about Germany leaving the euro. That would never happen because that would mean such an embarrassment for the Eurozone. And even though, the Germans are shouldering the brunt of the burden here, I think that, because of the ease of transactions and the benefits that have come with, part of the euro, they're going to do everything in their power to keep this in place. Let's see what other questions we have. Per month, 40 billion per month, and unlimited is what we got from the Federal Reserve. Let's see what else. Stock market addicted to QE, yep. Let's flip over to some of 135, I think, is a more realistic level for the euro dollar. If you watch the Money in Motion clip, we start off the show with me talking about that and why 150 is unrealistic. How high is the risk of Germany leaving the Eurozone? Once again, Joe, I think that the risk of Germany leaving the Eurozone is kind of low at this point. For yen weakness, who is the best pair with dollar, CAD, or euro? Actually, I talk about this on CNBC. It's basically this clip right here where I have the fast money behind me, where I lay out one of my favorite trades right now, which is euro yen. When will you have the material in Spanish? Sorry, I don't have the material in Spanish at all. When are we seeing 2007-2008 scenario currently being like 2007? That was right around when we were moving into possibly having a larger crash in 2008. In terms of how the euro dollar traded in 2007 and 2008, I'll show you for those of you that are not familiar, go to the monthly chart. We had a really nice rally followed by a crash in 2008. This crash was obviously caused by the global financial crisis. I don't think that the recessionary conditions around in Europe will cause this type of environment. We could be moving a period where we have a rally and a little bit of a pullback later on. This rally probably won't last for some time, but I don't think we'll have the 2008 scenario that we had back then. When trading the euro dollar on a technical basis, what do you watch in conjunction? I like to use my double Bollinger Bands, which I've talked about quite often. And if you haven't heard about them, just kind of do a Google search. There's a lot of information on that. Or you can pick up one of my books, which I talk about it quite extensively. What would be a good entry in the euro dollar if you missed the leg? We'll talk about that on our CNBC video, so I encourage you to read that, watch that. I believe Greece will leave the euro. What is your opinion? I think that that's a greater possibility than Germany leaving the euro. What is the main difference between ECB easing and Fed easing, since ECB made euro strong while the Fed made dollar weak? The Federal Reserve easing is much more aggressive because it's happening actively, whereas the ECB, remember, I told you that in order for it to even happen, a country has to beg for help first publicly, and that hasn't happened yet, whereas the Federal Reserve pretty much is starting immediately with their quantitative easing. Where will pound dollar go this week? Very big week for the pound dollar. I'll be writing about it, and I think we don't really have enough time to really go into the pound dollar here. A couple of weeks ago, you mentioned Aussie dollar going to 107. We are at 105. We had a really nice rally. Could be a possibility that we get to 107 in the Aussie dollar. I don't use Ichimoku clouds. Will the euro dollar slip to 130, 150 before rising upwards? I think that we could see a pullback towards that level. If so, that would be a good level for entry. Spain is needed to agree to have financial support and be willing to have 30 billion euros to receive bailout, right? Yeah, they need to be willing to agree to financial support for the sovereign, not for the banking sector. Gold's going to shoot all-time high. Well, it's going to try because all of these measures by central banks are very inflationary in the future, and also kind of devalues those currencies, making gold more attractive. So the last questions I'm going to take, please. Bear with me if you need to run out. If you have more questions, you can always email me or comment on our articles after you read them at BK Asset Management. We'd be more than happy to answer your questions there. When are we going to have Spain elections? I actually don't know the exact date that they're going to have Spain elections, but if you probably do a Google search, you'll probably find out when that's the case. Gold, silver will be better for trading than Forex and stocks the next few months. Not necessarily. I mean, you could have some good opportunities in FX as well. In terms of RBA minutes, read my piece that's coming out tonight on BK Asset Management. If you subscribe to our research, you'll get it in your inbox. I'll talk about the RBA minutes there. So with that, I'm going to say goodbye to you all. Fundamentals are so fun to talk about. It's always an evolving situation. So follow me on Twitter, read my research on BK Asset Management, and hopefully we'll be able to interact more there as well. Thank you so much, and hopefully you enjoyed this session. Oh, one more thing. For those of you that are Americans, we're going to be at the FXCM Expo in November. Please check out that. We're also giving some premium presentations that will be very, very good, I promise. So definitely check out the website and follow us there. Thank you so much.